When everybody hates something, that's generally something that you want to start looking at for an investment. Earlier this year, everybody hated utilities. Everybody hated real estate. Nobody wanted that. Now, people can't get enough of it. Let's talk about what you need to know before the bell. So this is the S&P 500, one we look at every day. On a buy signal, not extremely overbought yet, and flirting with all-time highs right now. So again, markets closed yesterday. We're sitting right at all-time highs. Nice triple top that's getting built right now. So kind of make or break for the S&P. The S&P either needs to break out to all-time highs, or we're going to kind of form a pretty significant level of resistance if the market fails later on today, following the Fed rate cut. We'll see what happens. But interestingly enough, while the S&P is doing this, the NASDAQ, which is more heavily tech-weighted, obviously, is not performing nearly as well. So you have kind of a very nice wedge pattern that is now building within the NASDAQ, and still well below kind of previous highs. And this is, kind of the thing that you want to be paying attention to here. So we've got the S&P at nearly all-time highs. The NASDAQ's not, but it's getting ready to start making a move. If it can break out to the upside today, the mega cap stock should start getting a bid here if we can kind of break out of this consolidation. But that kind of shows you that the rest of the market's been playing a bit of catch up here. And we see that, obviously, if we start looking at the S&P 500 Equal Weight, which is the equal weighted index, it's actually been making an all-time high. Now look, relative performance basis, the equal weight index is still way behind the S&P, but you are seeing much better performance here of the market. So, we talked about this real narrow breadth earlier this year. It was only the Mag 7 really driving market returns. That's certainly changed here as of late, but all these markets, the S&P, the NASDAQ, and specifically the equal weight index, is now very, very overbought here. And again, this is because of utilities and real estate and all those kind of defensive sectors that all of a sudden everybody kind of woke up and said, oh, look, let's buy some utilities because, of AI. Utilities have had a huge run here just since July. You've had a very, very big run in utilities. They're extremely overbought, extremely stretched. Real estate is the same way. We've had a big rotation, again, expectations of Fed rate cuts, lower interest rates, had a huge surge in real estate. So all of a sudden, and we've talked about this before, this is the one thing about investing to always remember, is that when everybody hates something, that's generally something that you want to start looking at for an investment. Earlier this year, everybody hated utilities. Everybody hated real estate. Nobody wanted that. Now, people can't get enough of it. This is the real estate chase for AI. It's the utility chase for AI. Natural gas is kind of been the new chase. So again, now everybody is in these trades. So now you got to start thinking about where is everybody going to go to next. And just remember that markets do rotate. What's in favor for a while is going to come out of favor at some point. Just remember that. Don't forget, and again, we're kind of in this position that we're about to start rebalancing our portfolio on this side. We're going to wait till after the kind of what happens today with the Fed, but probably Thursday or Friday, we'll rebalance our utilities and our real estate and things like that in our portfolio because they've just had huge gains in just a very, very short period of time. So again, and these are just extremely overbought. And like, for instance, real estate's about to trigger a sell signal from a very elevated level. So again, you're going to get a rotation at some point. So importantly, don't forget to take profits, rebalance your risk, manage expectations. I have no idea how today's going to turn out, so you may want to hedge that a little bit, ahead of that. If you've got a lot of real heavy equity exposure, maybe trim that back just a bit, going into the meeting. Again, not massively, just maybe take some profits, rebalance here. And if the Fed does cut 50 and the market rallies, great, you're still in. But there is a risk, like I said, of that kind of disappointment that could lead to a bit of downside in the market here short term if they don't cut by 50 basis points, and maybe even if they do. That's what you need to know before the bell this morning.